Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, August 27th, 2020. We wrote earlier this week that Fed Chairman Powell pretty much had to cross a tightrope to keep the markets in check and market friendly about Fed policy. And I would say he made it across the ravine. And everybody, and at least as of now, markets seem to be celebrating. There was a little bit of gyration early this morning, but you would kind of think that it was widely expected that he was likely to announce some sort of change to Fed inflation targeting policy. In other words, to be a little less eager to raise interest rates if inflationary pressures arose. Basically, more or less not target the employment numbers quite so much, because we realized that in the last round, when the economy was good just a few months ago, the labor markets were tight, but there wasn't a ton of inflation coming from them. He announced this policy, which was somewhat anticipated, if not widely anticipated. And markets like what they hear. Anything that keeps the Fed accommodative is good news for the stock market. For the bond markets, not so much. Bond yields have ticked higher across the board. The yield curve steepened because it does increase the likelihood that there could be inflationary. It certainly raises the likelihood of inflationary expectations, which is one of the big influences in real yields, or in the shape of a yield curve. If the yield curve is normally shaped, which is pointing, if you're looking at it, goes sort of up, left to right. Let me draw a little picture like that. The reason for that typically is, if you're expecting a pretty good economy, you'd expect some inflation in the system. The yield curve has been relatively flat. It is relatively flat, but it's steepening a bit because it opens the door for greater inflationary expectations down the road. Now, we're talking about a 10-year yield of a little over 70 basis points. That's not exactly something to worry about. And stock and bond markets can diverge for some time before they get before the bond market pressures really are felt in the stock market. Now, but looking forward, there's been a fascinating phenomenon. So we continue to rally, having rallied sharply every day this week. Monday and Tuesday were rallies, more or less. We were rallying, and then shot up in the last 15 minutes, which is either short covering, buy program, or some of each, or just markets following the pattern, which has been meander a little bit around the open, start to strengthen in the pre-market as we come in, sell off marginally by about 10:15 Eastern time, and then proceed higher throughout the day with a rally in the last hour or so. Yesterday was a little different. Everything rallied all day and strongly. But we have started to see some of the breakdowns. One of the days this week we did see the advanced decline line higher. The others we did not. Today we are actually, as we tape this, the advanced decline line is slightly positive. That's another thing that can diverge for a while, though. I did some research on this, and more or less the advanced decline line throughout the internet bubble failed to confirm the rally, which was continuing ever upward. So it's something to watch? Yes. The other thing that's something to watch is option markets seem to be saying something different than stock markets. Why do I say this? Because throughout these sharp rallies, we've really seen the VIX and its NASDAQ counterpart VXN ticking higher throughout the week. And that's something interesting because, okay, you can say it's the fear gauge, and you know that I don't love that nomenclature, calling it the fear gauge. Yes, when things are fearful, the VIX tends to be higher, but it doesn't measure sentiment. It measures market expectations of 30-day forward volatility, which is a very different thing than just saying how fearful are you. And there's some component. Basically, as we've discussed again, and we can point you to the videos that explain volatility, and I urge you to look at them if you're a little unclear. But Option traders are looking backwards and forwards at the same time. You're looking backwards at historical volatility, which is really, really low, depending on which measure you use, 8 or 10% annualized. That translates to about a half a percent, 0.6% daily moves. And that's about what we've seen. For the most part, the market's kind of gone up half a percent every day, pretty much. Also, but when we talk about implied volatilities, that's what markets are expecting or pricing in. Implied volatilities are usually above historical volatilities, particularly on big indices. Why? First of all, market makers need an incentive to sell volatility at lower levels. They want to get a profit, and as long as there's people demanding it, it's going to be above the historical level. Also, most historical volatility measures are looking at close to close price changes. Most market makers use some sort of measure that measures intraday volatility, where you have the range, and that range is usually greater than the high low. When you look at a candle, it's usually not just bottom to top. There's a range that's outside the 2-day closes. That's actually really hasn't been the case very much recently. The range is we've pretty much closed at the highs, which means and we really haven't tested any lows in a meaningful way. So more or less the historical volatility is the intraday volatility. So again, why are people paying up for this? Because it's a market determined rate. Somebody's got to be paying up for this. And the only conclusion I can come to is that there are people who are genuinely fearful of what's going on in the market. There's a couple of scenarios that make sense. First of all, you have Apple and Tesla splitting on Monday. So there are many who think that that's a buy the rumor, sell the news type of event. They've had very sharp rallies since they've announced their split, really on no other reason than that they're splitting. And I've told you it's the financial markets equivalent of making change. But it remains to be seen if there'll be any follow through based on that. And I suspect that there are some people betting against that. As far as Apple goes, yeah, that makes sense. As far as Tesla goes, who knows? Because that stock just exists in a mindset in a world of its own. But we'll see if the theory behind buying in advance of a stock split is it will create new demand for the stock after the split. I'm skeptical of that, and I suspect that other market participants share that skepticism. And that doesn't mean that either is likely to collapse, but perhaps that means that there's somewhat of a pullback, especially in the case of Apple being the most valuable stock in the U.S. That's going to any underperformance there could affect the indices in a big way. Of course, as you look forward, if you look at implied interest rates going out a ways beyond the 30 days, you get into the election, and I think people are expecting a fairly bruising election season with some twists and turns. And quite frankly, right now, prediction markets and pollsters are saying that favoring a Biden win and more or less a toss-up about the Senate. And I think the Senate is, in many ways, the more interesting one, because if former Vice President Biden wins the presidency and the Democrats capture the Senate, that would provide a clearer path for him to implement some of the tax policies that he's discussed, which includes the potential for a capital gains raise, and that's usually not very market friendly. But as of now, so I think the option markets are looking forward to that. The stock markets are just looking at the present. Stock markets are supposed to be a discounting measure, but yet I see them more or less just in momentum mode, reacting to the present. The other thing, of course, is the calendar is going to turn next week, and we get into September. September, October have been known for their surprises. And I think those of us with longer memories have a history of knowing that. I think some of the newer market participants may not be quite so aware of the fear factor that enters the market as we get into the September-October period. And particularly yesterday, we saw the economic numbers have been generally okay. The labor market today was not awful. I think but it wasn't good either. The number of new jobless claims this week. Also, yesterday we saw consumer confidence really miss, and the expectations component was pretty low. That's often a warning sign. But I do think if you want to really get down to it, I think the main reason that you see the VIX so high is institutional investors who have to be invested but don't really particularly believe in the valuations, think that the market is stretched. They're buying, but holding their nose while they do so. Their way of doing that is buying the market, following the trend, and hedging yourself with options to do that. Um, in general, that's an okay strategy. Yeah, it takes some points off your returns if you're hedging, but for the mean, until this is one of these strategies that's working until it stops working. I don't particularly love it, but I have to embrace it because right now the momentum is so strong. It's not clear what turns it, although the option market is starting to look for those signs, and I've outlined what could turn it, but that could be some ways away. Anyway, that was a really long one today. I'm sorry about that. Hope you made it to the end. Take care, everybody. Bye bye.